Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're just verifying the audio. All right, looks like the audio is working. We're just going live on all the platforms. If you have questions or topics you want to discuss, please chat those over. Okay, great. Welcome to our daily Solo 401k webinar and Q&A session with My Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic, Mega Backdoor Roth Solo 401k explained, how to go tax-free in 2025. This is your chance to get answers, so please use the chat now to ask questions on today's topic or anything else. Please chat them over so that we can be sure to get to them all. Let's get started. So as always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So again, we want to discuss the Mega Backdoor Roth Solo 401k explained as the opening topic. But if you have other questions or topics, please chat those over now. As you can see from the image, most 401ks block the ability to make Mega Backdoor Roth Solo 401k contributions. Here's how you can unlock it. That's what we want to unlock for you today. So what is the tax-free opportunity? Well, for 2025, one could potentially contribute up to $81,250, where the funds end up in a Roth account where they can grow on a potentially tax-free basis. Now, you'd have to be age 60 to 63 to get up to that amount, but even for those that are under age 50, the contribution limits are $70,000, which is 10 times how much one could contribute to a Roth IRA. And then if you're age 50 plus, it goes up to 77,500. And then you could do the catch-up contribution if you're age 60 to 63 and you have the self-employment income to justify the contribution. So what we're talking about is making a voluntary after-tax contribution and then converting the funds either to a Roth Solo 401k or a Roth IRA. So that's what a Mega Backdoor Roth Solo 401k contribution entails. Now, note that this is much more advantageous than a standard Roth IRA contribution, not only because the limits are so much higher, 10 times, for example, but also because there's no income limits. So unlike with a Roth IRA, where if someone makes too much money, they're not eligible to make a Roth IRA contribution, there is no such income limit above which one cannot make a solo 401k contribution. So there are no income limits. So even if you make a relatively high amount of money, you're still going to be able to maximize the contributions to the solo 401k. So ultimately, this could be perfect for high earners. And the control stays inside your solo 401k. So only you have control. For example, we don't have access to your accounts. You have control. You have control over the accounts, over the investments, over how much you contribute, whether you contribute all as Roth or even make some as pre-tax and Roth, for example. Now, the foundation is that you need to be eligible. You need to be eligible to set up a solo 401k. So solo 401k plans are for owner-only businesses. So you need to be self-employed. So specifically, you need to report earned self-employment income. So what that is depends on how your self-employed business is taxed. So in the case of someone who's, say, taxed as a sole proprietor, let's say you're a 1099 independent contractor, or you've got a single member LLC that's taxed as a sole proprietorship, earned self-employment income is going to be income reported on Schedule C of your 1040. Whereas if your business is, let's say, taxed as an S Corp or a C Corp, earned self-employment income would be the W-2 wages that you receive from your self-employed business taxed as an S Corp or a C Corp. Then finally, in the case of a self-employed business that's taxed as a partnership, earned self-employment income is income that's reported on line 14 of the K-1 that you receive from your partnership. So that's one prong of the eligibility criteria, that you need to be self-employed. And the way that you prove that is by reporting earned self-employment income. The other half of the eligibility criteria is that you need to not have any employees. Specifically, you cannot have any full-time W-2 employees. Of course, other than yourself or a spouse, if any, or another business owner. So you cannot have any non-owner, non-spouse, full-time W-2 employees. So that means that your spouse can participate. In order for your spouse to be able to participate, your spouse needs to be working at the business and reporting your spouse's own earned self-employment income, such as their own Schedule C or their own W-2 in the case of a business taxes and S corp. Ultimately, this means this is ideal for solopreneurs who might be consultants, realtors, freelancers, or other small business owners. So what is the Mega Backdoor Roth? So being eligible means that you could set up a solo 401k, but that you might just set up a vanilla solo 401k, a basic solo 401k. But there are more advanced solo 401k plans, like the one that's offered by my solo 401k Financial, that would allow you to make these Mega Backdoor Roth Solo 401k contributions, which is how you're eligible to max out those contributions where they go into a Roth account. That's how you can go tax-free in 2025. It's via that Mega Backdoor Roth Solo 401k. So Mega Backdoor Roth is really like a online term or a marketing term. Really what that refers to is a specific transaction where you first make a voluntary after-tax contribution, and those voluntary after-tax contribution limits are much higher than even your standard Roth Solo 401k contribution limits. They're 10 times higher, for example, than the Roth IRA contribution limits. But you need to have a plan that allows you to make those voluntary after-tax contributions. But that's just the first step. That's how you get the higher amount of money into the plan. But you want it to grow potentially tax-free. So then you got to go to the second step of moving the funds to a Roth account. So you've got two options. You can move the funds, those after-tax contributions, either to the Roth Solo 401k, so keep it inside the plan. Maybe you want to preserve the ability to take a 401k loan. Maybe you want to preserve the ability to invest in alternative investments. Because, for example, our plan does allow for investing in not just typical brokerage type investments, but true alternative investments like real estate, crypto, etc. The other option would be to transfer those after-tax funds out of the plan to a Roth IRA. In either case, the funds will end up in a Roth account where they will be just like any funds in a Roth account. In other words, where they will have the potential for tax-free growth. Potential because you will need to satisfy the qualified Roth distribution rules. So for example, with respect to a Roth Solo 401k, you would need to wait to withdraw the funds once you're 59 and a half or older and have had the account for at least 5 years. In that case, you could take out all the funds, including the gains, totally tax-free. And then finally, as mentioned up above, in contrast with the Roth IRA, there are no income limits. So even if you make a relatively high amount of money, you're still going to be able to make these Mega Backdoor Roth Solo 401k contributions if you qualify. In other words, you're self-employed with no employees. You set up a solo 401k plan, like the one offered by my solo 401k Financial, that allows you to make the Mega Backdoor Roth Solo 401k contributions, and you've got the self-employment income to justify the contributions that you want to make. Why most solo 401k plans can't do it? Because their plan documents don't allow it. The company's made a business decision just to offer a vanilla plan. So all your basic brokerage solo 401k plans, your major brokerage solo 401k plan providers do not offer a solo 401k plan that supports the Mega Backdoor Roth. So they're not going to allow you to make the contributions. They're not going to provide the support that's needed, such as the compliance reporting that's required when you make a Mega Backdoor Roth Solo 401k contribution. So for example, Fidelity, Schwab, Vanguard, down the line. Most providers exclude the ability from their plan documents to be able to make after-tax contributions. And they also don't allow you to do the in-plan Roth conversion, because remember, the plan document has to allow for both the voluntary after-tax contribution and then the subsequent transfer to the Roth account so that the investments can grow potentially tax-free. How we enable it is we provide an IRS approved plan document that allows you to make these contributions. In other words, our plan document allows for both the voluntary after-tax contribution and then the transfer to the Roth so that the gains can grow potentially tax-free. But that's just basics, right? That's just the minimum, is to be able to have a plan document that allows for the contributions. It's also going to make sense to work with a provider that has experience in helping thousands and thousands of customers make these mega backdoor Roth contributions like we do, so that we can guide you through the required steps, because are specific steps that you have to follow, right? You have to deposit those voluntary after-tax contributions into a separate after-tax account. So we're very hands-on in helping customers open up the requisite number of accounts. And we're totally neutral as far as where the funds are, right? We don't hold your money. We're not trying to hold your money, but we help our customers open up accounts where they want to open up accounts. For example, Fidelity, for example, Schwab. Those are the top two brokerage options. We'll prepare the paperwork to help you open up the accounts at Fidelity or Schwab. And then you've also got the compliance reporting. So remember, it's a two-step process. You first make the voluntary after-tax contribution into the after-tax account. So that first step, the after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return. It doesn't need to be reported on the W-2, for example, in the case of a business that's taxed as an S Corp or a C Corp. But the second step, when you move the funds from the after-tax account, either to a Roth Solo 401k or a Roth IRA, that does need to be reported. It needs to be reported on a 1099-R issued by the plan. So we handle that 1099-R reporting as an optional free service for our customers. Customers just have to let us know about that transfer, and they can do it easily. There's a form on our website that they can submit the information 24/7. Then we add their plan to the queue to be able to prepare that 1099-R. And again, we do that as an optional free service. In other words, no additional charge. So the step-by-step, how it works explanation, again, is contribute the after-tax funds to the Solo 401k, then convert immediately to the Roth. You actually could go either to a Roth Solo 401k or a Roth IRA. That way the gains can grow tax-free potentially. Report the conversions, right? So you want to make sure that you submit that form on our website to give us the information we need so we can prepare the 1099-R. Then invest, right? Invest in typical brokerage type investments or even alternative investments, because our plan allows for both. Here's a quick example to show how someone might be able to turn $81,250 into tax-free wealth for 2025. Let's assume the individual is a consultant, they're self-employed, they're age 61, they have $150,000 of self-employment income. So for 2025, they're going to be able to make not only the employee contribution of $23,500, but also a super catch-up contribution that's now allowed under the Secure Act 2.0 of $11,250. So their total employee deferral amount could be up to $34,750. And that could go directly into a Roth Solo 401k. Now, this assumes that they're not making an employee contribution to another plan like a day job plan. Now, then they could skip the employer contribution, right? Of course, our plan allows for employer contributions, but let's assume that this individual is focused on making Roth and Mega Backdoor Roth contributions. So they might just skip making employer contributions, and that's totally fine. So then they can do the difference up to $81,250 as an after-tax contribution. So that would amount to another $46,500, which would again first go into an after-tax account, then be moved, converted to the Roth Solo 401k. So at the end of the day, they have $81,250 in their Roth Solo 401k that has that tax-free growth potential. Why a specialized Solo 401k provider is necessary? Well, it comes down to the documents at a minimum, but it also makes sense to work with a provider like my Solo 401k Financial that has deep experience, provides hands-on support through the required steps, handles the mandatory 1099-R reporting for that subsequent conversion as an optional free service, because ultimately you need those custom plan documents, and it's going to make sense to also work with a provider that has the support, has the experience, etc. So of course, we offer fully IRS approved plan documents. We provide the support for the after-tax and Roth conversions, trusted by over 10,000 solopreneurs. And as mentioned up above, we're totally neutral. In other words, we're flexible in terms of where the accounts are at. So it could be at Fidelity, could be at Schwab, or many other brokerage firms, as long as they're willing to open up accounts for a third-party plan. And again, we're very hands-on in helping our customers open up the requisite accounts. Thank you so much for checking out today's session. If there are questions or topics, please chat those over. I see we've got one now. We'll start to go through the questions. Don't hesitate to chat them over so we can get to them all. So if your goal is to maximize the Roth contribution, is there any reason not to just skip employee deferrals and just contribute everything via after tax? No, there really isn't, Alex. That's a great question. So it's certainly acceptable to just contribute 100% as voluntary after-tax contributions and then transfer those funds to the Roth Solo 401k or Roth IRA. With the one exception would be if the individual is eligible to make catch-up contributions, because a catch-up contribution cannot be made as an after-tax contribution. It needs to be made as an employee deferral. So that's $7,500 if they're age 50 plus, or $11,250 if they're age 60 to 63 for 2025. So if you're making the catch-up contribution, you would make that directly to the Roth Solo 401k and then just do the difference, right? So the other 70,000 as an after-tax contribution and then move it from the after-tax account to the Roth account. Wonderful question. Thank you so much for bringing it. If there are more questions, don't hesitate to chat it over. If this information is helping you feel more confident about your future, please take 1 second to like and subscribe. Liking tells the platform that this content is valuable, which helps other solopreneurs like you find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Yes, thank you so much for the great participation. We also want to invite you to our community. We have the largest community of solopreneurs and solo 401k owners. You can join. It's totally free. All are welcome. You can join easily and quickly at mysolo401k.net/my community. We have vibrant forums, active forums. We have a library of videos and webinars. So there's tons of ways to learn. There's tons of ways to share the knowledge. So please don't hesitate to join if you're not already a member. All right, well, that looks like it's it for today's session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Thank you so much, everyone. All the best.